For decades, the middle class has been described as the backbone of modern society. It has symbolized stability, opportunity, and the promise that hard work leads to a comfortable life. A steady job, a modest home, reliable health care, the ability to raise children without constant financial fear, and maybe even take a vacation once a year. This was the standard image. Politicians praised it. Economists measured it. Families aspired to it. But quietly, gradually, and almost imperceptibly at first, that foundation has been eroding. The disappearance of the middle class is not dramatic like a market crash or a recession headline. It doesn't happen overnight. Instead, it unfolds through rising costs that outpace wages, through shrinking job security, through debt that grows faster than savings, and through opportunities that become increasingly uneven. It feels less like a collapse and more like a slow squeeze. One of the clearest signs of this shift is wage stagnation. For many workers, real wages adjusted for inflation have barely grown over the past several decades. Productivity has increased dramatically. Technology has made businesses more efficient. Workers are producing more value than ever before. Yet the share of that value going to employees has not kept pace. The gains have flowed disproportionately to executives, shareholders, and owners of capital. This disconnect between productivity and PE creates a quiet imbalance. On paper, the economy grows, corporate profits climb, stock markets reach record highs. But for the average middle-class worker, the paycheck feels increasingly tight. Rent rises, groceries cost more, utilities creep up, insurance premiums swell. Meanwhile, salary increases, if they come at all, barely offset inflation. Housing is one of the most visible pressure points. In many regions, home prices have far outpaced income growth. What was once achievable on a single income often now requires two full-time earners. In some cities, even dual-income households struggle to afford a modest home. The dream of ownership shifts further away, especially for younger generations. Renters face similar challenges. Rental prices have climbed steadily in urban centers and increasingly in suburban and even rural areas. When a larger portion of income goes toward housing, less remains for savings, education, healthcare, or retirement. The financial cushion that once defined middle-class security thins out. Education, once considered a ladder into the middle class, has become both more necessary and more expensive. College tuition has risen dramatically over the past few decades. Students often graduate with significant debt, entering adulthood already financially burdened. That debt delays homeownership, family formation, and long-term investments. It also narrows career choices, pushing graduates toward higher-paying jobs rather than meaningful or community-based roles. Healthcare costs further strain middle-class stability. Even those with insurance can face high deductibles, copays, and out-of-network expenses. A single medical emergency can wipe out years of savings. Medical debt remains one of the leading causes of personal bankruptcy. The constant fear of unexpected health expenses creates a background anxiety that quietly undermines financial confidence. At the same time, the nature of work itself has shifted. Stable, long-term employment with pensions and strong benefits has become less common. Many companies have replaced defined benefit pensions with defined contribution plans, shifting risk from employer to employee. The gig economy has expanded, offering flexibility but often lacking security. Freelancers, contractors, and part-time workers may not receive benefits, paid leave, or retirement contributions. Job security, once a hallmark of middle-class life, has corporate restructuring, outsourcing, automation, and global competition mean layoffs can occur with little warning. Workers are expected to continuously adapt, retrain, and relocate. While adaptability can be empowering, it also introduces constant uncertainty. Globalization has played a complex role in this transformation. On one hand, it has reduced costs and expanded markets. On the other, it has exposed middle-income jobs to international competition. Manufacturing, once a reliable source of middle-class employment, has declined in many advanced economies. Some jobs moved overseas. Others were automated. Communities built around factories and plants have faced long-term economic decline. Automation and technological advancement continue to reshape the labor market. While technology creates new industries, it also eliminates certain roles. Routine and repetitive tasks are particularly vulnerable. Many of the jobs being created require either highly specialized skills or fall into low-wage service categories. This polarization squeezes the traditional middle tier of employment. Income inequality has widened significantly. As wealth concentrates at the top, the relative share held by the middle shrinks. This concentration influences not only financial outcomes, but also political and social dynamics. Those with greater wealth can exert more influence over policy, regulation, and economic structures, potentially reinforcing systems that favor capital accumulation over wage growth. Tax structures and policy decisions also contribute. Changes in tax rates, capital gains treatment, and corporate taxation can shape how wealth is distributed. When policies disproportionately benefit high earners or asset owners, the gap between the wealthy and the middle class widens further. Another subtle but powerful factor is the rising cost of raising children. Childcare can rival mortgage payments. Education-related expenses, extracurricular activities, and healthcare add up quickly. For many families, having children introduces significant financial strain, even when both parents are employed. Retirement security has become more uncertain. With pensions declining, individuals rely heavily on personal savings and investment accounts. Market volatility introduces risk. Not everyone has the financial literacy, income, stability, or employer support needed to build sufficient retirement funds. Many middle-class individuals face the prospect of working longer or retiring with less security than previous generations. Debt has become a defining feature of middle-class life. Mortgages, student loans, car payments, credit card balances, these obligations accumulate. While debt can enable opportunity, excessive debt creates fragility. When unexpected events occur, job loss, illness, economic downturn, heavily indebted households are less resilient. Cultural expectations also play a role. The social definition of middle-class success often includes homeownership, higher education, reliable transportation, and certain lifestyle markers. As costs rise, maintaining this standard requires more income than before. The pressure to keep up can lead to overextension and financial stress. Intergenerational mobility, long a promise of middle-class societies, shows signs of slowing. In some regions, children born into middle-income families have less upward mobility than in previous decades. Access to quality education, safe neighborhoods, and professional networks often correlate strongly with parental income. Geographic inequality compounds these trends. Economic opportunity clusters in specific metropolitan areas, often with high living costs. Those who cannot afford to move may remain in regions with fewer opportunities and slower growth. This spatial divide reinforces income disparities. The COVID-19 pandemic exposed and accelerated many of these vulnerabilities. While some professionals transitioned remote work and even increased savings, many middle-income workers faced layoffs, reduced hours, or health risks. The uneven recovery further highlighted structural imbalances. Small businesses, traditionally a pathway to middle-class prosperity, face increasing challenges from large corporations and digital platforms. Economies of scale, supply chain advantages, and access to capital give large firms a competitive edge. As small businesses struggle, community-based economic diversity declines. Financial markets have increasingly rewarded asset ownership. Those who own stocks, real estate, or businesses benefit from rising valuations. Those who rely primarily on wages see slower gains. Because asset ownership is unevenly distributed, wealth accumulates faster at the top. Inflation, even at moderate levels, disproportionately affects middle-class households. Essentials like food, energy, and housing consume a larger share of income. When prices rise faster than wages, purchasing power erodes quietly. Social safety nets vary widely across countries. In places with limited public health care, child care support, or unemployment benefits, middle-class households must self-insure against risks. This requires higher savings and increases vulnerability when savings are insufficient. The psychological impact of this slow erosion is significant. Financial insecurity affects mental health, relationships, and long-term planning. When families feel one setback away from crisis, optimism declines. Trust in institutions can weaken. Political polarization often intensifies in periods of economic strain. As middle-class security declines, frustration grows. Competing narratives emerge about causes and solutions, yet the structural complexity of the issue makes simple answers elusive. It's important to note that the middle class has not vanished entirely. Rather, it is shrinking in relative size and stability. Some households move upward into higher income brackets, others slip downward. The defining characteristic is increasing volatility. Fewer people remain steadily in the middle over long periods. Technology companies and financial institutions have become central drivers of economic growth. These sectors often generate significant wealth, but employ a relatively small share of the workforce compared to traditional industries. This dynamic concentrates gains among a narrower group. Educational attainment increasingly determines income potential. Those without advanced skills face limited opportunities in a knowledge-driven economy. Yet access to quality education remains uneven, reinforcing inequality. Urban development patterns can exacerbate class divides. Gentrification raises property values and rents, displacing long-time residents. While cities may flourish economically, lower and middle-income households may be pushed to peripheral areas with longer commutes and fewer services. Transportation costs, often overlooked, add to financial strain. Car ownership, fuel, insurance, maintenance, and public transit fees accumulate. In regions without efficient public transportation, mobility becomes expensive. The cultural narrative of individual responsibility sometimes obscures structural factors. When middle-class families struggle, they may blame personal choices rather than systemic shifts. This can delay collective responses or policy reforms. At the same time, consumer culture encourages spending. Easy credit and digital commerce make purchases seamless. While consumption fuels economic growth, it can deepen household debt. The decline of labor unions has also influenced middle-class stability in some countries. Unions historically negotiated higher wages, benefits, and job protections for middle-income workers. As union membership declines, bargaining power shifts toward employers. Financial literacy gaps can widen outcomes. Understanding investments, retirement planning, and risk management is crucial in a system that places more responsibility on individuals. Those without access to quality financial education may fall behind. Demographic changes intersect with economic trends. Aging populations increase pressure on pension systems and healthcare infrastructure. Younger workers may face higher tax burdens or reduced benefits in the future. Immigration can influence labor markets in complex ways, contributing to growth while also affecting wage dynamics in certain sectors. The impact varies by region and policy framework. Environmental challenges and climate change introduce new costs. Insurance premiums rise in high-risk areas. Natural disasters disrupt livelihoods. Transitioning to sustainable energy systems requires investment that can shift economic structures. Digital transformation continues to accelerate. Artificial intelligence and machine learning promise efficiency gains but may displace additional categories of middle-skill work. The long-term balance between job creation and displacement remains uncertain. Cultural shifts around work-life balance add nuance. Some individuals prioritize flexibility over income growth. However, flexibility often comes with trade-offs in stability and benefits. The narrative of meritocracy persists, yet structural barriers complicate equal opportunity. Networking, social capital, and inherited wealth influence outcomes beyond raw effort or talent. Public infrastructure investment plays a role in supporting middle-class prosperity. Quality schools, transportation, broadband access, and healthcare systems create foundations for economic mobility. Underinvestment can weaken these supports. Regional economic diversification matters. Communities reliant on a single industry are more vulnerable to shocks. When industries decline, recovery can take decades. Monetary policy influences borrowing costs, housing markets, and asset prices. Low interest rates can stimulate growth, but also inflate asset values, benefiting those who already own them. Corporate governance trends emphasizing shareholder value may prioritize short-term profits over long-term workforce investment. Decisions about automation outsourcing, and cost-cutting often reflect these priorities. Cultural perceptions of success can amplify stress. Social media highlights lifestyles that may be unattainable for many, reinforcing feelings of inadequacy despite stable incomes. Access to affordable childcare significantly impacts workforce participation, particularly for women. Without support, families may reduce working hours, limiting income growth. The structure of retirement systems increasingly depends on market performance. Economic downturns close to retirement age can dramatically affect savings. Healthcare tied to employment creates additional risk. Job loss may mean loss of coverage, increasing insecurity. Legal and regulatory environments shape business practices, labor standards, and consumer protections. Policy shifts can either cushion or intensify middle-class pressures. Technological platforms concentrate market power. Dominant firms can influence wages, prices, and competitive dynamics across industries. Civic engagement often declines when economic stress rises, yet engagement is critical to shaping policies that address systemic issues. The concept of the American dream, or similar national ideals in other countries, has long been tied to middle-class expansion. As upward mobility slows, belief in these ideals may weaken. Despite these challenges, adaptation and innovation continue. Remote work opens new geographic possibilities. Online education expands access to skills training. Entrepreneurial ventures create alternative pathways. However, adaptation requires resources, information, and stability, qualities that become scarcer as the middle class thins. Ultimately, the quiet disappearance of the middle class is not the result of a single policy or event. It is the cumulative effect of technological change, globalization, policy decisions, demographic shifts, cultural norms, and market dynamics interacting over decades. The transformation raises fundamental questions about economic structure and social cohesion. A robust middle class has historically supported democratic institutions, consumer markets, and community stability. Its contraction alters the balance. Reversing or stabilizing this trend likely requires multifaceted approaches, investment in education and training aligned with evolving industries, policies that support affordable housing and healthcare, tax structures that balance growth with equity, and labor frameworks that adapt to modern work realities. It also requires acknowledging complexity. Simplistic explanations rarely capture the interplay of forces at work. The middle class is not disappearing in a dramatic collapse. It is being reshaped, squeezed, and redistributed. For some, opportunities expand. For many others, the shift unfolds quietly in monthly budgets, in postponed plans, in longer working hours, in delayed retirements. Understanding this transformation is the first step toward addressing it. The story is not solely about decline, but about transition. Whether that transition leads to a more inclusive prosperity or deeper stratification depends on collective choices made in the years ahead. The quiet erosion of middle-class stability serves as both warning and invitation. A warning that economic structures are not so, and an invitation to rethink how prosperity is generated and shared. In the end, the middle class represents more than an income bracket. It represents a sense of possibility, grounded in security. When that security weakens, societies feel it not through headlines alone, but through the daily lived experiences of millions of households, compromising and recalibrating their expectations of what a stable life looks like. And it is in those small recalibrations, the decision not to buy a home, the delay in starting a family, the second job taken quietly, the retirement postponed, that the disappearance becomes most visible, not as a single event, but as a generational shift unfolding in slow motion.